Good evening, everybody. It is Thursday, June the 16th. We're about an hour after the market closed, and markets took a beating today. But something interesting is going on in the debt market. Let's talk about it. Let's talk money. Let's talk market wrap-up. All right, everybody. So first things first, as usual, thank you very much for tuning into the channel. If you like today's content, please like, share, subscribe, but most importantly, comment. I really want to hear what direction you think the markets are going to take next. But let's jump into the markets, because today, beating. Absolute beating. Dow Jones finishes down 741 points. S&P 500 down 123, and that's a really big number. And the NASDAQ, which took the most, down 4%. In other words, 453. TSX here in Toronto, down 3%, 607 points. So really rough day right across the board for the most part for most equities, with the exception of commodities, but we'll talk about that in a few moments here. The main thing I want to talk about is not only did we see the markets, the actual indices take a beating, but the US dollar also took a beating, down 1.24% or $1.30, a massive drop in the US dollar, or the Dixie, at least that's the relative strength of the dollar. The other interesting thing I want to talk about, and really it's going to be the focus of this video here, is the 10-year yield. Did you see what happened with the 10-year yield today, the US 10-year yield? It dropped 5.72%, currently sitting under 3.25. It's actually 3.201 right now. An incredible move to the downside, but the question really is what sparked it. So yes, there's a lot of fear out there and people have bought into bonds and safety of bonds, but the interesting thing is usually you'll see a dollar spike as well when it's a broad stroke movement of fear. But in this case, the 10-year yield dropped very, very significantly, indicating a significant amount of buying. And we're not just talking about fear buying here or fear moves into the 10-year yield. Oh, no. I think we're talking about institutional buying into the 10-year yield, or buying up the bond market. And the reason I say that is because yesterday, and we only touched on it briefly, the European Central Bank did talk about deploying special tools to help prevent fragmentation of the debt market. And I did mention briefly that they really only have two sets of tools. One is interest rates and the other one is money printing. Now, I think what the central bank is trying to do, the European Central Bank here, is trying to print enough money to try to buy up the debt market as much as possible to try to create some stability here. Sure, and that sounds great, but at the end of the day, all that's doing is creating a massive amount of inflation. You're printing more money. You cannot print inflation away. And so here is the problem. You can raise rates on one end but it's not going to do anything because you're not raising them enough. So instead, you're going to print more money to try to save the debt market from an implosion that will eventually trigger a collapse of the equities market, which I think is going to happen anyways. But inflation is going to keep going out of control. It's still going to impact the market as traders continue to see what's going on as far as inflation is concerned. Never mind the atrocious employment numbers that came out today, manufacturing numbers that came out today. Just all around horrible news as far as U.S. economics is concerned. Then here in Canada, you have Freeland, who is going to try to keep printing money as well. There was an article posted today in the National Post. I don't have it pulled up here, but I think you should go take a look at today's article. While we're chatting, I'm going to try to pick it up here. But at the end of the day, Central banks are all going to have to follow suit with the European Central Bank. Now that that standard has been set, you can expect the Fed to do it, and you can expect the Bank of Canada to do it. You can expect every central bank around the world to follow suit and try to save the debt market. Again, why would they be so overly concerned? The debt market, or the equities market, is essentially a derivative of the debt market. If the debt market collapses, falls apart, fragments, you can expect that to definitely follow suit with the equities market. In fact, it is the precursor to a collapse of the equities market. If we take it a little bit further today, we also had, and this is going to account for why the equities market also collapsed, at least why they're trying to blame the early part of the trading session today. And that's on the Swiss Central Bank and their move raising interest rates higher and calling it unexpected, which I can't really understand how it was, considering inflation has become a global crisis. And yes, it is a crisis. And I've talked about it before. We will move from crisis to crisis to crisis. In fact, the European Central Bank, with this bond purchasing or their special tools here, are calling it an emergency measure to try to stabilize the debt market. So that's another reason. On top of that, I read earlier today that investing.com has said that the significant part of today's drop throughout the trading session is again continued recession fears after the hawkish view by the Fed. Well, maybe. I mean, this should have been yesterday's reaction. The market should have pulled back yesterday. We know there was probably some institutional buying by the Fed yesterday, propping up the market based on the bad news that came out. But today was a different beast. Today, the debt market was fully bought up by central banks. That's it, everybody. Do I think it's done? Do I think that the markets are going to recover here? Well, there's one of two things that are going to happen at this point. We are very near the bottom of a market pullback due to central bank buying and the comfort and ease knowing that central banks around the world will prop up the debt market, continue to print more money. And after we reach the bottom here, we're going to bounce up and everything is going to be fantastic again. Markets will move back up to all-time highs. Bubbles will continue to be created and inflated. And everybody's balance on their trading accounts, on their savings accounts, on their income accounts will go back to normal. Or the reality will set in that all measures are failing to control inflation. Economies are continuing to collapse. We're really just doing a temporary measure to help either slow down the debt collapse or unsuccessfully try to stop one. And the equities market will react very, very, very negatively. I guess that remains to be seen. Either direction is very viable, very possible. I am leaning more towards the fact that the economic factors will eventually catch up. Inflation, that's certainly not going anywhere, will eventually play a bigger role. And I think the markets will continue to see more downside, possibly after a short bounce, but significantly lower than where we are today. So where do I think money is going to go now? I'm still a big believer in commodities, not that I'm recommending that to anybody else, as your portfolio should be reviewed with your advisor, and make sure that you know whatever investment you choose, you understand the risks involved. But I think commodities are where money will start to move. In fact, if we take a look at commodities today, it was the only, for the most part, sector that saw a significant amount of green. Gold and silver were up. Copper was the only metal that was down. Platinum, palladium, all up. Brent crude was down, but West Texas crude was up $1.71. Looking right across, agriculture for the most part was up. Even livestock was up. So again, commodities, physical assets are where I feel the next swing will be. Could absolutely be wrong. If the markets continue to move up, then obviously that's going to spread and we can reassess a portfolio at that time. But for now, that's where I am looking for my own portfolio. And cryptocurrencies are taking a continued beating here. Not sure that I'm really confident in putting anything towards Bitcoin at this point. It's still down around 20,798 right now. Ethereum really getting close to dipping below 1100. So we have not seen a bottom with cryptocurrencies. So I'm going to stay away for now, but not selling any holdings, but definitely not buying anything yet, but definitely taking a look at commodities. Now that's it, everybody. I will see you tomorrow morning at the opening bell.